Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. In my previous video, I talked about the 4 major risks of investing in Chinese stocks we should know about. I talked about the current cybersecurity reviews, data collection issues, antitrust law, and the variable interest entity VIE structure that are affecting all Chinese stocks. Because of all the current Chinese regulatory crackdowns, Chinese internet stocks represented by the Crackdowns CSI China Internet ETF here have plunged as much as 50% from the recent peak this year. In this video, I'm going to talk about are Chinese stocks already near the bottom and when will Chinese stocks recover? I will cover these topics in this video. Are Chinese stocks still uninvestable and too risky now? Have Chinese stocks bottomed already? When will Chinese stocks recover? What is the worst case scenario? What happens when Chinese stocks are delisted? And what is my portfolio strategy going forward? If you like this video, make sure to smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a VIP patron. You will be able to follow all the stocks I'm buying for the long term, watch exclusive investing weekly videos, and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you know when a stock is currently overvalued, fairly valued, or undervalued. The link is in the video description. Take a look. Let's start. If you're interested in Chinese stocks like me, the most important questions you may ask are Chinese stocks uninvestable and too risky now? Are Chinese stocks a value trap? Or are Chinese stocks substantially undervalued now? There are 2 perspectives to this. The first perspective is that Chinese stocks are too risky and uninvestable even if they're substantially undervalued now. The second perspective is that Chinese stocks are too undervalued to pass now and that they should eventually recover even if there will be more Chinese regulations going forward. Personally, I believe we should look at both perspectives, the bear perspective and the bull perspective, to see if Chinese stocks are uninvestable. Here's the bear perspective. If you have been following Chinese stocks recently, you will notice that the current Chinese regulatory crackdowns are affecting all the major Chinese tech stocks such as Alibaba, Tencent Holdings, Baidu, JD.com, DD Global, and Meituan. There are many regulatory crackdowns that are negatively impacting all Chinese tech stocks now. These Chinese regulations include the anti-monopoly law, cybersecurity reviews, cybersecurity law, data security law, personal information protection law, new regulations banning Chinese educational companies from listing overseas and making profits, and new rules that will limit children under 18 years old to play online video games up to 3 hours per week. As far as I know, there will be more new Chinese regulations going forward. No one can predict which Chinese companies and industries will be targeted next. George Soros, one of the most famous hedge fund managers in the world, wrote this article to explain why he exited Chinese stocks. According to Financial Times, he said, investors buying into the rally are facing a rude awakening. That includes not only those investors who are conscious of what they're doing, but also a much larger number of people who have exposure via pension funds and other retirement savings. Then he said, in MSCI's ACWI ESG Leaders Index, Alibaba and Tencent are 2 of the top 10 constituents. In Black Box ESG Aware Emerging Market Exchange Traded Fund, Chinese companies represent a third of total investments. These indices have effectively forced hundreds of billions of dollars belonging to US investors into Chinese companies whose corporate governance does not meet the required standard. Obviously, no one will know whether George Soros is right until several years later. In my opinion, I believe we should keep in mind all the major regulatory risks that are affecting Chinese stocks now. The second perspective, which is the bull perspective, is that many Chinese tech stocks are substantially undervalued now. If you look at how much they have dropped from their recent peak in the middle of February this year to now. For example, if you look at the Crackdowns CSI China Internet ETF here, the ETF dropped as much as 57% from its recent peak in the middle of February to now. This ETF mainly invests in China-based internet-related companies. In my opinion, I believe many Chinese tech stocks are undervalued now if we consider many of them have dropped as much as 50% or more from their recent peaks this year. Of course, there are Chinese stocks that are value traps now that I believe we should stay away from. Value traps are stocks that appear undervalued with a very low PE ratio, but they are value traps because their businesses are no longer growing, or they are no longer as competitive as before, or their businesses have been greatly impacted by regulations they have no control over. For example, I would consider Chinese educational companies such as TAL Education and New Oriental Education and Technology as value traps. Their stocks have dropped as much as 90% since February this year. They are now banned from raising capital overseas. As required by Chinese regulations, they will need to turn into non-profit organizations. So have Chinese stocks bottomed already? Personally, I believe there's a good chance that Chinese stocks in general are near the bottom. For example, if you look at this Nasdaq Golden Dragon China Index here, you can see this index has dropped as much as 50% from its recent peak in the middle of February to the middle of August this year. This index started recovering recently since the middle of August. If we compare the current correction with the previous corrections here, you can see Chinese stocks tend to have large market corrections every several years. Obviously, no one can predict where the bottom is, but based on my experience, in most markets, a 50% market correction from the recent peak would usually cause many investors to start investing again because they believe the market is near the bottom and because they want to invest in undervalued stocks such as undervalued Chinese tech stocks, even if they still have a lot of regulatory risks. The next question is, when will Chinese stocks recover? Historically, according to this Nasdaq Golden Dragon China Index chart here, the last large correction that started in June 2018 took approximately 2 years to recover. There was a smaller correction that started in June 2015. It took almost 2 years to recover. There was a larger correction in May 2011. It took slightly over 2 years to recover. Then there was the world financial crisis that started in late 2007. It took this index almost 10 years to recover. Again, no one can predict how long it will take the current Chinese stock market to recover. I can only speculate that it should take Chinese tech stocks 2 to 3 years to recover. Personally, I don't think it should take Chinese tech stocks as long as 10 years to recover, which is what happened during the global financial crisis that started in late 2007. The current regulatory crackdowns in China are not as bad as the global financial crisis that happened between 2007 and 2009. I actually went through the global financial crisis between 2007 and 2009. It was much worse than the current Chinese regulatory crackdowns. What is the worst case scenario for Chinese stocks going forward? The worst case scenario is that Chinese stocks could be delisted from the US stock exchange going forward, either because the Chinese regulators are banning Chinese companies from listing overseas, or because the US regulators are delisting Chinese stocks using the Holding Foreign Companies Accountable Act, HFCA Act. Under the HFCA Act, Chinese public companies such as Alibaba and Baidu will need to be delisted from the US stock exchange if their books cannot be audited by the US Public Company Accounting Oversight Board, PCAOB, for 3 consecutive years. This means they could be delisted as soon as 2024. According to this Bloomberg article here, Securities and Exchange Commission Chair Gary Gensler has a warning for hundreds of Chinese companies that have raised billions of dollars in US markets. Submit to more scrutiny soon or get kicked out. In a Tuesday interview, he pledged to strictly enforce a 3-year deadline that requires Chinese firms to permit inspections of their financial audits. If businesses refuse, their shares could be delisted from the New York Stock Exchange and the Nasdaq as soon as 2024. I want to show you this Bloomberg article here that explains how Chinese regulators could ban Chinese public companies with a lot of sensitive data from listing in the US. According to this Bloomberg article here, China will propose new regulations to block companies with large amounts of sensitive consumer data from floating shares in the US. China's stock market watchdog has told companies and investors that envisioned rules will prohibit firms from listing abroad, particularly those seeking a foreign IPO via overseas incorporated entities. Sectors with less sensitive information, such as pharmaceuticals, remain likely to win approval for an IPO. The regulations could be finalized and implemented only around the 4th quarter. So the agency has asked some companies to suspend IPOs till then. I talked about this in my previous video. China restricts foreign ownerships and investments in sectors such as the internet, media, telecommunication, and education. In order to go around China's restrictions on foreign investments, Chinese companies such as Alibaba, JD.com, Tencent Holdings, DD Global, and Baidu need to use variable interest entities VIEs to go public in the US. VIEs are essentially shell companies created in foreign jurisdictions such as the Cayman Islands. When we are buying Chinese American deposit receipts, ADR shares such as Alibaba ADR shares, we are not directly investing in Alibaba. We are actually investing in Alibaba's VIE shell company, thus contractual agreements with Alibaba in China. One of the biggest risks is that Chinese regulators could ban Chinese companies from going public in the US using the VIB structure. In my opinion, I believe the chance of Chinese regulators banning the VIE structure altogether is small because it will prevent Chinese companies from being able to raise capital overseas going forward. If Chinese regulators ban VIEs altogether, large institutional investors will likely stay away from investing in Chinese stocks going forward. I believe a much much more likely scenario is that Chinese companies seeking to raise capital overseas using the VIE structure will ask for Chinese regulators' approvals first going forward. So what will happen when Chinese stocks are delisted from the US stock exchange? This is from Bloomberg. In a forced US delisting, firms that already sold shares in Hong Kong like Alibaba and JD.com can migrate their primary listing to the city. The delisted US receipts, which can still trade off exchange, won't be worthless because they represent an economic interest in the company. Hong Kong's open markets and greenback-pegged currency should facilitate the conversion. Holders can sell their ADRs before they are delisted or convert them into the Hong Kong listed common stock without much disruption. A company choosing to terminate its ADR program entirely can also pay out a dollar amount to investors. If Chinese stocks are delisted in the US, investors will need to sell their ADR shares very likely at a much lower price. Also, according to this Bloomberg article, we should be able to convert Chinese ADR shares to their shares listed in Hong Kong. Of course, the Chinese company will need to have their shares already listed in the Hong Kong Stock Exchange. This is why more Chinese public companies are starting to list their shares in Hong Kong now, in case their ADR shares are dislisted in the US. Chinese companies such as Alibaba and Tencent Holdings that have ADR shares listed in the US and shares listed in Hong Kong can also buy out investors' ADR shares. Personally, I've not tried converting my Alibaba, Tencent Holdings, and JD.com ADR shares into their shares listed in Hong Kong. I will need to call my broker to find out how to convert my ADR shares to their shares listed in Hong Kong. So what is my portfolio strategy going forward? Last year, I was very lucky that I sold a portion of my Alibaba and Tencent Holdings shares because I wanted to free up cash in my portfolio. I still have Alibaba, Tencent Holdings, and JD.com ADR shares in my growth stock portfolio. I am planning to hold my Alibaba, Tencent Holdings, and JD.com shares for many years because I like their businesses and their economic prospects. I also believe the Chinese equity market will eventually recover. To reduce risks in Chinese stocks, I will continue to keep my Chinese stocks at less than 5% of my growth stock portfolio. This is just my personal preference to reduce risks. I will continue to invest mostly in the best US tech stocks because I like US-based tech companies the most. The main reason is that the US regulatory environment, in my opinion, is much more stable and much more shareholder-friendly than the Chinese market. Personally, I believe it's important not to overweight in Chinese stocks going forward, meaning not to allocate too much money in Chinese stocks, even if many Chinese stocks are substantially undervalued now. This is because there will likely be more new Chinese regulations going forward. No one can predict which Chinese companies and sectors will be targeted next. In the future, I may consider switching my Alibaba, Tencent Holdings, and JD.com ADR shares to their shares listed in Hong Kong. I will need to call my broker to find out what is the best way to switch these ADR shares to their ordinary shares listed in Hong Kong. To summarize, I believe Chinese tech stocks represented by CraneShares China Internet ETF are near the bottom at the time making this video. It seems Chinese stocks have already started recovering recently, but if there are new major regulations in the upcoming months, then Chinese tech stocks could head into corrections again in the short term. Historically, the most recent Chinese market corrections took about 2 to 3 years to recover. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. I always say this, make sure you always do your research and do your extra due diligence first before investing in anything. If you like this video, make sure to smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a VIP patron. You'll be able to follow all the stocks I'm buying for the long term, watch exclusive investing weekly videos, and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock is currently overvalued, fairly valued, or undervalued. Thank you for watching this video. This is Victor from the Intelligent Investor channel, and I will see you in the next video.